Now, one of the driving factors behind China's decision to transform its model of economic development is the surge in international crude oil prices. Crude is well above $60 a barrel, down from breaking $70 highs. This week, I talked to Dr. Jin Huang, chief economist of FedEx Services. He explained the impact of rising crude price on China's economy. In general, what would you say is the impact of the rising crude oil price on China's economy?
The market perception is the high crude oil price is a drag to global economy, its economic growth. It is as if an added tax on consumption. It also cut directly into the corporate bottom line. I think the impact on China is through two channels. One is China currently import about 40% of oil need. So as a result, the reliance on global oil market is pretty significant. It is a legitimate concern in terms of the impact on growth sustainability at the current pace. In addition, China, because of the export structure and China's role in global supply chain, China is actually playing a pivotal role in global supply chain management. As a result, China also has significant exposure to the external environment. The high oil prices may negatively affect trading partners, the US, Japan, Europe, and so on. So as a result, it will also likely have a negative impact on Chinese economic growth.
Now, actually, if you look at the United States, which is one of the largest trading partner of China, currently about 1/3 of Chinese exports go to the U.S. market. And if you analyze the U.S. consumption market now, the domestic consumption has already started to decline because actual oil price has risen over 3 times if you consider inflation as a factor. So do you think this is a signal that China should transform itself from a export-based economy to another model, and what would be a good model for China now?
It's a very good question. I think China is already in the process of transforming from an export-led growth model into more of a balanced domestic demand, export growth balanced model. The 2 previous episodes that you referred to were considered as a supply shock to global oil market. This time, the general perception is slightly different. It's the demand-driven situation. The pressure is mainly from the demand side. With this said, the significant run-up starting from the end of February, almost 60% growth surge in crude oil prices may not closely align with market fundamentals. So hopefully, sometime down the road, the demand price mechanism will kick in. The market will eventually adjust itself or balance itself.
You said China's already started the process of transforming itself from a export-led economy to a domestic consumption-driven economy. How do we actually do that at this point in time? Because at the very beginning, you already mentioned the increasing crude oil price has slowed down many domestic consumption, not only in the U.S., but also in China. So at this time, how do we actually achieve that?
China, like any developed country, is following a 3-stage growth model. You always, in terms of economic evolution, you always start from increasing demand in energy and commodities. That is already happening. It's unfolding, and I think that is one reason that's lifting up, or at least perception-wise, the demand or consistent demand on oil and other commodities. The second stage is once the middle class is emerging and strengthening, the demand on consumer durables like automobiles, household appliances, and so on will increase dramatically. And that will also create a very different situation. You will have more sophisticated consumption pattern down the road, more choices. To some extent, I think China is entering the early stage of this second phase. To some extent, it will also help to address the trade imbalance situation. You provide more opportunities for the U.S., for the European countries, for example, in terms of providing the luxury good, the high end of consumer electronics, even in the auto area and so on, to participate directly in the Chinese market. And the last stage I haven't mentioned is capital market, the mature and the growth of capital market.
Actually, most of other Asian countries or economies have merged into a manufacturing supply chain centered around China. So if China decides to take the approach, as you just mentioned, how do you think this will change the dynamics of a regional economy in the Asia-Pacific region?
Now, I think when you look at the secular trend, China's role in global supply chain is not a cyclical thing. This is a secular long-term structural change that is taking place. With the sophistication of Chinese educated labor and the manufacturing structure, and extending into more service-oriented product offerings, China will play even more significant role. So I think this is a process that's going to steadily strengthening down the road. And the market is big enough to provide ample opportunities for other countries in the region. I think generally speaking, this is a plus for the region as a whole.
How do you predict the increase in crude oil price to affect China's GDP growth rate?
I don't have a specific numbers. It depends on many things. It really depends on many things. How long the oil price will sustain at what level, and the impact through which channel, through the wealth channel in terms of the equity market valuation, through the pricing channel, inflation pass-through, through the impact on disposable income and so on. There are so many possibilities, but it is, I think, prudent or safe to say the impact has to be watched closely, or the direction of oil price has to be watched closely.
Dr. Huang said this is a good time for China to start using alternative energy in a massive way in order to improve manufacturing efficiency.